Hi everybody and welcome along for the Single Asset Funds at Mint Asset Management Update. With me today you've got myself, David Fife, and Tom Deacon as well, who's going to join us to talk through what's happened in the month of March. So just rolling through to the drivers for the month.
Hi everyone, my name's Tom Deacon, Senior Investment Analyst for Mint's Australasian equity funds. Globally, inflation and unemployment have been a key focus area for markets as we all look for the timing of rate cuts. In the US, core services inflation has ticked up in recent months and the jobs market has remained resilient, much more resilient than anticipated at the start of the year, and that's reinforced a slower rate cut trajectory for markets. Down in this half of the world, the pace of jobs growth in New Zealand continues to slow and is now below the growth in working age population. Net migration plays an interesting role here, and we see unemployment even ticking up slightly over the next couple of quarters, and this should surely rule out further rate hikes from the RBNZ. In Australia, inflation across food and energy items is also likely to weaken materially over 2024, lagging recent price declines across ag, commodities, and wholesale gas and electricity markets. Core goods inflation, on the other hand, is still a little bit strong, but is likely to remain above target as softer tradables inflation is only partially offset by those stickier inflation elements of new dwelling prices. In New Zealand, core services inflation is still sticky as well, while most other baskets are behaving. Overall, we see some inflation and unemployment moving in the right direction across ANZ, albeit slightly slower in terms of returning to those bands than we would have hoped. Risks remain, though we still see rate hikes beginning in the second half of the calendar year, and this is likely positive for equities, we think. The next big question for markets will be, the likely severity and timing of a potential earnings recession, and so we're looking for ways to mitigate risks from those perspectives. In terms of the performance of the AET fund in March, it was driven by the underweights in stocks that struggled. EBOS was the main attributor here. Investors continue to see Chemist Warehouse contract loss as a major crimp to FY25 earnings, and its share price performance potentially seeing it out of some indices. Spark and Chorus were among the other two names sold by investors as long bonds increased with stronger than anticipated labour and inflation data, as I mentioned before, in the US market. In terms of the negatives, lackluster performance in overweights, Meridian and Serco were there as well. Share price bounce and Sky City was sort of one of the other main attributors in March. Meridian Energy seemingly caught up in a sell-off in yield-sensitive assets as long bonds rebounded, and Serco, on the other hand, has seen some owners de-risk ahead of its FY24 result and renegotiation of Keybooking.com JV contract, which is ongoing. Sky City's share price continues to be volatile with news flow around regulatory proceedings, a key focus for investors and some value investors sort of pitching in there. In terms of portfolio changes this month, we've introduced Telix Pharmaceuticals into AET. Telix presents a compelling investment opportunity, we think, within cancer diagnostics and therapeutics. Structural growth and precision cancer medicine is a key driver. Lots of research and development and market adoption going on there. They have successfully commercialized PSMA prostate cancer diagnostic product Illuccix, and that is continuing to grow strongly and take market share. There's some interesting pricing and patient mix elements sort of ongoing with that product. That business has a very large R&D pipeline, and we are very excited about the coming sort of phase 2 and 3 trial results there. We think overall Telix presents a potential asymmetric return upside for investors, and in our view, $13 or under presents pretty compelling opportunity to realise market mispricing of the key Illuccix product as a relatively cheap option value across the R&D product pipeline. Over to you, Dave.
Excellent, thanks for that, Tom. And then closer to home in terms of the New Zealand market and I guess the SRI fund itself, we saw a really strong market in New Zealand, up over 3% for the index. And I guess what drove that, it was very much the larger end of town. Names like Fisher and Paykel, A2, Infratil and Auckland Airport were sort of the stronger ones for the month. And as Tom touched on, some of the sort of the longer dated bond like names like Spark were a bit softer. And again, we saw an update on GDP for the month that did see Q4 into negative territory, if only just. Technically a second recession in the last couple of years. But I guess what was telling about that was more what I call the retail fail, which has been a few of the retail names that have struggled, and a couple of them reported in the month. Kathmandu was the first. I think the chart I've included here is quite telling around the Kathmandu brand within that business. Just how you look at Macpac's interest over time has increased, and whereas web traffic, whereas Kathmandu's has sort of fallen. So they acknowledge themselves market share has not played well. Also at the moment we know that the New Zealand and Australian consumer has started pulling back, but Ripkill, the other brand they own, has done okay, but again is exposed to wholesale markets, especially offshore, and we have seen ordering cycles sort of lower, and then the restocking post the destocking has been at lower levels as well. So from a wholesale perspective, been challenging, and of course they have their winter sales ahead of them, and that's where they'll look to try and catch up, but it continues to be challenging outcome. And the Warehouse was another name we saw struggling again. They are sort of rebuilding, redissolving their business back to the old, which is to their core, which is the blue and red sheds. And Noel Leemings, as they've recently exited Torpedo 7 for $1, not the best investment, writing $50-60 million off in the meantime. And also we know, and again, for their market share to Kmart has been pretty poor. They've been sort of losing in the home and apparel division. So yeah, not looking good, and even guidance outlook for the near term is pretty soft end as well. In terms of names within the fund, as again, energy markets were strong. Contact energy has continued to tick upwards. Wholesale prices have remained elevated, and that supported that name, and also Meridian, which Tom touched on. Another name out there which actually had a tough month is Comvita. It's an interesting one at the moment. We know there's a non-binding offer out there for the name. It has struggled in the past, but actually, we'll be interested to see what happens there. It's approaching almost 2 months since that bid eventuated, so we will see where that lands. But for us, an interesting point is that its book value of the business is just over $3. So if we do see a bid emerge, we sort of expect it to be within that range. We will see. And then within the fund itself, we sort of topped up a couple of property names within the fund, and have reduced some of our retirement exposure through Ryman Healthcare. And again, moving over to the REITs, another strong month. This is the outperforming sector within the New Zealand market, and the fund itself has had another strong period. In terms of the names themselves, we didn't get a lot of reporting. We did see at the short end, the government bonds of 3-year, step down about 20 bips or so, which has supported the market. So we did see a lot of the names rally. So hence our underperformance with the names that we just have less of. But the outperformance again have been skewed to some of our names that have a bit more of a data and digital focus. Around Goodman Group has done very well again on the data center thematic. So that was quite interesting. And we also saw an update from KPG in terms of valuations for the quarter, with a lot of the companies in the REIT space reporting in May for the March year end. We will see some valuation updates. And from KPG, it was actually rather flat update. So a bit of a mix there with some of their mixed-use assets ticking up a little bit, and their office and retail ticking down, which is no surprise given the current environment. So we'll look to see how we go from there. But thanks everyone for dialing in for the month. As per normal, if you have any questions or want to get in touch with us, info@mintasset.co.nz, and we hope you've had a great month yourself, and look forward to updating shortly again.